So Derek and I were talking the other day about some kind of novel strategies that we can use with clients who are expecting to have their net worth increase over time, which is what most people kind of expect to happen, and how we could kind of tie that in with an efficient, financially efficient way to do some long-term care planning. So the topic we're going to talk about today is how to use long-term care almost like term insurance. I'm here with Derek, my cousin and business partner. Hey Derek, how's it going?
Hey, good, Drew. Yeah, the topic is, as you mentioned, is really how can you use long-term care, traditional long-term care insurance as term insurance, and at the same time allocate a portion of your assets and then have them growing safely in an equity index annuity with the hope as the annuity grows over time, you can kind of create your own long-term insurance account and self-insure your risk. And then eventually the goal is to drop your long-term care insurance premium so you don't have to pay it anymore.
Yeah, and we'll break this down. We'll kind of go through it step by step, but essentially the hope is with the current as of early 2025, the current index based annuities that pay income, you can turn on an income for life. They also have a growth component. There's like two sides of the shop kind of thing. And so that's the growth is non-guaranteed. So we need kind of sort of use this strategy to hedge a little bit just in case. But if the market does do well over time, there's a good chance, like you said, we can drop that long-term care policy. Now, I guess the immediate question is why buy it in the first place if you're planning on dropping it? Maybe we should address that elephant in the room right away.
Right. Yeah. There's several companies, right? Equity index annuity companies that are offering products that will guarantee you a 10% simple return each year for the next 20 years on the income side. And what that means is at any point in between 1 and 20 years, you can choose to turn on a lifetime income. So as each year passes and you're banking that 10% simple return, your income value grows. So the longer you defer that payment, the higher the income will be. Now, if you need long-term care in the first couple years, you've only banked, a couple years of interest on the annuity. So you really need to, let it grow 5+ years. And then at a certain point, and that'll just be kind of, really just based on your personal financial uh, situation at that time, you may be able to just drop the long-term care insurance because your annuity's value will have increased so much to where now it's kind of acting as your long-term care retirement.
Right. So
Um,
we're able to lock in your good health, which is extremely crucial with traditional long-term care plans, not on the annuity side so much, but we're able to lock in your good health and your younger age and remove that risk should something happen in the sort of short to midterm. On the other hand, there is the risk that if the annuity income amount is not satisfactory, you might need to buy long-term care at that point at a much higher price, or you might be uninsurable. So really, we're kind of locking in your health and age, but we're hoping that at some point we can cancel that long-term care policy if things work out and the strategy plays out properly. If it doesn't, we're covered either way.
Yeah, and it could be something to where if your annuity payment, because again, this is the whole idea is to eventually grow this lifetime guaranteed annuity payment. It's paid in cash. You can spend the money on whatever to a high enough level to offset the long-term care where you don't need it anymore. But if that's not the case, then maybe you could reduce your long-term care insurance in half. So if you had 5 grand a month in benefits, maybe cut it to 2,500 and in exchange for reducing your premium by 50%. So there's you can always decrease your long-term care insurance, but really the hope with this strategy is you can eliminate it altogether.
Right. Yeah, I think it's a smart way to hedge the risk and well, eliminate the risk, but also hedge the future risk as well. So that's why we wanted to talk about it. So kind of breaking down these income annuities a little bit further, kind of the general principle is you put in a single premium, and the number that I'm seeing lately is around 300,000, but we do some as low as 200, maybe even a little less than that. In fact, I've got a call this afternoon with a guy who's going to do 150. So you can go lower, but essentially it's a one-time lump sum upfront payment. And then you don't have to make the decision today, but let's explain to him how they turn that on.
Yeah, so the income value of the account will be growing. There's 8% compound out there. There's 10% simple. There's 8.5%. Whatever income rate that you sign up with, that's it'll grow at that rate for a set number of years. So, if you had a 10% simple return over 10 years, if you put 150,000, like to your example, it'll be 300,000. It'll exactly double in 10 years. So then the insurance company will take that $300,000 and they'll assign a percentage. They'll guarantee you this percentage of the 300,000 for the rest of your life based on your age. And so, just roughly, it's usually around 7 to 8%. So if it's 8% of 300,000, the insurance company will guarantee you $24,000 for the rest of your life, no matter how long you live.
Right. So, and this is a number that we can look at today. It's a guaranteed number. So it's not, a made up number in the future. We can look at a page today and say, if you put in this much money and you wait this many years, and at that time you opt to turn on an income, this is what it'll be guaranteed, which is a really nice feature of these annuities. They're actually currently paying more than a typical SPIA annuity, which is where, you put in money and immediately flip on an income. These are actually outperforming a SPIA annuity, with the other side of the coin being the growth story, the potential for the growth of your valued index to markets.
Yeah, that's the whole goal, is for the actual market return to beat the guaranteed income value, because that's what's gonna grow your lump sum walkaway value. So, it's not guaranteed to do this, but there's plenty of Fidelity, Morgan Stanley, Goldman Sachs. There's a Nasdaq, there's an S&P, all these various indexes that your money is growing with. They've averaged anywhere from 7 to 13% per year for the past 10 years. It's not guaranteed to repeat that, but that's the hope is in the next 10 years, it'll repeat in some form or fashion, to where you've actually outpaced the income value. And if that's the case, you obviously take the higher value.
Yeah, yeah, and it's not a decision you have to make now. You can just kind of let it roll and see how it goes. And then, let's say that we're in a pretty hot market right now. Let's say it just tanks and people's equities go down 50%. This is not going to have that issue. And that's why we think for a lot of people, they need to take some chips off the table. Not a lot, like we always say, we're big fans of the stock market. But take off a small 10, 20% of your chips and put it in something that's guaranteed while we're at all-time highs in the market. You might thank yourself later.
Yeah, so a lot of people are using these equity index annuity as bond fund replacements, because for that very reason, if the market does go down, and the market, it'll have a correction. It always seems to correct, 4 or 5 times over a 20-year cycle. And I think 2022, the market was down 30%. So if you have a portion of your assets in these with some guarantees attached, you don't have to worry about it. It's almost like peace of mind. And the last thing I wanted to mention on these equity index annuities, why they're becoming an increasing beneficial way to plan for long-term care, is they will, on that income payment, going back to that example, the 24,000, if you need long-term care and they define that as needing help with 2 to 6 activities of daily living, they'll double that payment for 5 years. So the annuity, in long story short, the annuity market is much more competitive than it was 3 years ago. So you have a lot of these companies competing for your business, and they're offering these little incentives to gain your business, and that's one of them. They'll double your income payment for 5 years if you need long-term care.
Yeah, so just to wrap it up, there's basically two roads we can go down. If you're healthy, we would layer two different policies together, the traditional long-term care and the annuity. If you're health challenged, and a lot of people are for various reasons beyond their control, we can do an annuity strategy if you're able to defer. Now, if you're in the nursing home right now or it's imminent, the annuity strategy for long-term care typically is not ideal. But if you're willing to defer, even as little as 5 years, we can make a pretty compelling case for the equity index annuity options that have the income rider on them. So it's a very specific product. And like you alluded to, Derek, They're not all the same. They're all a little bit different. We have access to multiple ones. In fact, you and I were on a call yesterday and learning about a brand new option. We're always trying to find what is best on the market for our client base.
Yeah, exactly. Well, if you'd like to learn more about long-term care insurance, equity index annuities, we'll leave our link to our website and our phone number in the description below. But we're LTC Tree. We work for you, not one company. We'll shop the market and find you the best product based on your age, health, gender, state you live in, and with one source.
Yeah, absolutely. So if you're curious, no pressure. Give us a call on our 800 number. One of us will probably answer, or our assistants, or check out our website at ltctree.com and we'll shop the whole market for you. All right, let's wrap it up, man. Have a good one.
You too. See you, Drew.
All
Bye.
right, bye bye.